Supply and demand is a key concept to trade financial markets. It is also referred as to bearish or bullish order block. So as you can see here on the screen, a supply zone is a bearish order block and a demand zone is a bullish order block. The reason behind this is because a supply area is an area where you're looking to sell, and then in a demand area, you're looking to buy more orders. Now, in general, order blocks are found all over the charts on all time frames. So what you can do on one time frame can be done on any other time frame. It's not limited to a specific time frame, whether it's higher or lower. Order blocks are all valid on all time frames, and it simply indicates a large grouping of orders being placed at a specific price level. Okay, so in this example of a supply area, there was a large stacking of order within this candle here before price impulsively leaving and creating this big bearish candle. Okay, now when you see these impulsive moves happen in the markets, this is what I call a BFI footprint. This is where the banks and financial institutions got involved in the markets, right? Stacking enough orders to move the markets in a specific direction, because we know that the volume that banks and financial institutions are trading, the volumes they are trading isn't the volume that retail traders is trading, right? So they can't just click on one button and get filled completely, right? So they're stacking a bunch of orders within an area before price pulls out into a certain direction. Now, a key thing to note about order blocks is that the impulsive move should be breaking structure to be considered valid and high probability. So let me give you an example of what this would look here within this supply area or this bearish order block. So let's say we had somewhat of an impulsive move down here, price kind of gravitating back into this area, right? Creates a little range, and then this is the last candle, that last bullish candle before the impulsive move to the downside, which breaks this previous structure point. So given this information, we now know that we have a bearish order block. Now, to draw an order block, in this case a supply area or a bearish order block, you would draw it based on the last bullish candle before the impulsive move, moving away from that area. Okay, and the idea behind that is that the institution that place orders often aren't able to facilitate their position or their full position in one go. So price rapidly moves, and then essentially within this big impulsive move, we'll see this in subsequent videos, but this would have left a lot of inefficiency in the market or imbalance, where price tends to gravitate back to in a corrective manner. And then as soon as it taps into the order block that we have drawn, then it fills the remaining of the pre-existing orders that were left initially, right? Grabs it and then pushes lower to create a lower low in this case. And in the case of a demand area or a bullish order block, it's the same, except it is drawn on the last bearish candle before the impulsive move, moving away from the area where there was a large volume or large order flow for the banks to get involved, right? Now, because there was imbalance in the market or inefficiency left in the markets, price gravitate back to these areas to balance the markets or to balance price, then taps into this order block where there's pre-existing orders that were left initially, right? Grabs these orders and then pushes higher to create a higher high in this case. We essentially use order blocks as a framework to enter trades either long or short, depending if it's a bullish or a bearish order block, right? Now we're able to enter or to find an entry either at the distal point. So in the case of a supply area, this would be your distal point, or at equilibrium. And your point of equilibrium will be the 50% mark of your supply area. And this really ultimately comes down to your personal preference. Either or is fine. And then the stop loss would be placed just above the order block, because technically if this order block is pushing away and breaking a break of structure, right, making a break of structure here, this would be your high, and then at some point this would be your low. And for price to continue within this bearish momentum, it should not break above the previous highs, right? Same thing with the demand area, or the bullish order block. Your distal point would be at the highs here, and then your equilibrium point would be at the 50% mark of this area. And just for illustration purposes, price can really tap, deeper within that level of demand. And once again, your stop loss would be placed. Let's say in this case, we enter at the top, at the distal area. We would place our stop loss. I usually put it 2 pips below or 2 pips above in the case of a supply zone. And then, of course, your targets would be higher. We essentially use order blocks as a framework to enter trades, either long or shorts, depending on the order block, whether it's bearish or bullish, right? Whether it's a supply area or a demand area. Now we're able to base an entry at either the proximal point or the equilibrium point of either order block. So in the case of a supply zone, our entry could be either at the proximal point or the equilibrium point. And the equilibrium point is simply the 50% mark of the bearish order block in this case. So for example, if we're entering a trade at equilibrium, we would have our entry at this point, and essentially our stop loss would be placed at the distal line, okay? And we would leave some space for the spreads. I usually do 2 pips above, right? And then your targets would be towards the lows or the extension points, right? Now, same thing for a demand area or a bullish order block. In this case, we would have possible entry either at the proximal point or the equilibrium point, and our stop loss below the distal line, right? 2 pips below it, and our targets at the previous highs or in your extension levels. A supply zone or a bearish order block is essentially a bullish candle before a large impulsive bearish move that breaks structure to the downside, creating a lower low. And essentially the way we want to trade this is price gravitating back to the order block, since this would have left inefficiency in the market or imbalance. So price gravitates back to an area where there's pre-existing orders, pre-existing volume, to rebalance the price and then push lower. Now similar, a demand zone or a bullish order block, in this case it is a bearish candle before a large impulsive bullish move that breaks structure to the upside, creating a higher high. So you see here where this big impulsive move to the upside broke the previous structural high, right? And then within this big impulsive move, this would have left inefficiency and imbalance in the market. So price would gravitate back to an area where there's pre-existing orders and where there's liquidity to rebalance the price and then push to the upside. There is 2 entry options based on the order blocks. We can either enter on the bearish order block at the proximal point or the equilibrium point. Same thing with the demand zone, right? Either the proximal or the equilibrium point, and your stop loss will be placed at the distal line, and you would add a buffer of about 1 or 2 pips. I usually do 2 pips to factor in spreads and little slippage just in case. We essentially use order blocks as a framework to enter trades either long or short, depending if it is a bullish or a bearish order block, right? So we're able to base an entry at either the the proximal or equilibrium point of the order block. In both cases, you can see here on the charts, the proximal point is the first or the closest entry area in the order block, and the equilibrium is the 50% mark of the total order block. Same thing with the demand area, but in this case, the proximal point is higher than the distal since we are looking to buy. And then the equilibrium is once again the 50% mark, and the distal point is the lowest point of the order block, right? The furthest or the farthest point within the order block. So your entries can be based on the proximal and equilibrium, whereas your stop loss will be based on the distal line, factoring in a few extra pips for spreads and slippage, usually 2 pips above it or 2 pips below, depending if it's a supply or a demand area.